You're watching the program that identifies market trends, provides insightful analysis, and reliable research. Key elements to help you profit from the pros. Profit from the Pros is brought to you by Zacks Investment Research. Learn more by visiting them online at Zacks.com. Welcome to Profit from the Pros. I'm Terry Ruffalo. Investor concern over Greece's debt crisis eased a bit this week as the country reported it had reached an austerity plan with European authorities. Here at home, Fed Chairman Bernanke had nothing positive to say regarding the U.S. economy. After the Fed's two-day meeting ended at midweek, it downgraded its assessment of the economy's performance, but gave no indication that it will take any new steps to boost growth or jobs. That caused the market to stumble just a little bit at midweek. We got word that the International Energy Agency member countries will release 60 million barrels of oil in order to help ease prices, and the U.S. will kick in about 30 million of those barrels. Oil stocks trended lower on that news about Thursday. Among the economic news reports that came out that investors took note of this week was word that durable goods orders rose more than expected in May, and the final revision for GDP growth in the first quarter was pegged at 1.9%, slightly higher than the second revision, but in line with analyst expectations. And we're going to talk a little bit more about that at the Roundtable a little bit later on that you'll want to stay tuned for. Kevin Matris is here with us. He is our market technician. After a big correction, an increase in volatility, a lot of news floating around out there coming from all directions about the state of the economy, about the markets. Tell us, what does the market look like from a technical perspective?
Well, let's start at the beginning, right? At the end of April, the Dow closed at a high of 12,810.
Okay.
But then, starting on May 2nd, the market began a 6-week long correction, getting as low as 11,862, and that was a drop of 948 points, or minus 7.4%. Now, from a correction standpoint, that really wasn't that big of a deal. However, though, seeing the market go down week after week after week for 6 weeks in a row, it really felt a lot worse than it was. And to be sure, there were plenty of stocks that went down more than just 7.4%. So it really did feel worse than it was.
Pardon my persistence, but is the correction over?
Well, that seems to be the question on everybody's mind. So here's my take, all right? Okay. Let's take a look at a slide.
All right.
If you were to draw a line from the low in March of 2009, which is when this bull market began, right? And if you were to then connect it to the reactionary low that we had seen in July of last year, which, that's when everybody thought the market was going to collapse again. If you were to draw that line extended all the way out to today, you can see that the market hit that in both of the last 2 weeks, and it bounced higher in each time. So I have talked about this trend line before, and at least for right now, it kind of looks as if that trend line is holding.
A lot of people focusing in on the 200-day moving average as well. How does that factor in?
Well, I look at that 200-day moving average as well. So let's take a look at this chart again.
All right.
You can see that by looking at this chart, that 200-day moving average is just underneath that long-term trend line. And quite frankly, I believe that the market has pulled back enough. It got close enough to that 200-day where I would consider that to be a successful test. Okay. However, if that trend line that we have drawn up here, if that trend line is taken out, I would believe that within 100 points or so, I believe that that 200-day moving average will still stand. And currently, the trend line comes in at 11,928, and the 200-day moving average comes in at 11,769.
Okay. And if those levels get taken out?
If those levels get taken out, what I am looking at is this. I would imagine the next support would be 11,555. That is the low that we had seen in March of this year. Then if that's taken out, then I believe that we would see the high of the consolidation pattern from July of last year, which comes in at 11,258. So those would be the next levels of support. But at the moment, I kind of think that the trend line and the 200-day should be able to stay intact.
Okay, so for now, you think the trend line lows, or at least the 200-day, is going to hold, right? Just be clear about that.
Yeah, knock on wood. Even with the Fed Fed's downward revision of the economy and, concern about employment, there's still a lot of good things happening in the economy, right? Especially with stocks. You have low valuations, record corporate profits, an earnings yield that is better than anything else out there. So I really do believe that we do have some upward room to move.
So what's the best advice you can give investors right now?
I would say that you want to look at companies that are in the top sectors. We talk about this in the Screen of the Week segment. I think that's a great thing to do. Mm-hmm. Second, you want to focus in on stocks with both growth and value. A lot of people are reluctant to pay up for growth right now, so if you're looking at growth but also low valuations, there is more room for those stocks to move. And also, too, I would say focus in on stocks in established uptrends above their moving averages. I think that is a safe bet, and I think that you'll be able to weather this storm and make money even if this market chops around.
Yeah, that's important, being able to weather the storm before moving forward. You're going to pull up a screen for us a little bit later on in the program and join us at the Roundtable.
Correct.
And we hope you'll stay with us. Here is your Bull and Bears Stock of the Week. A large staffing firm and a retail holding company. This week's Bull and Bear of the Week. Shiraz Mian here with us once again to kind of explain why for each of them. Now, the large staffing company is Manpower. They are the Bull of the Week, MAN, the ticker symbol. Kind of took me just a little bit by surprise, given all that's going on with the jobs front these days and lack of people working. But I'm sure you'll tell us why this is the Bull.
Yes, there are a number of negatives that everybody is aware of, and the dominant theme in the labor market is that it's improving, but improving very slowly. And unemployment, particularly in the U.S., but also globally, is quite high. But Manpower and many other staffing firms have a very strong leverage to this slowly improving labor market. About 50% of their placements are in the industrial end market, 30% clerical, and then 20% in the high-end professional, heavily weighted towards temp placements. And in the current environment, when employers are uncertain and kind of tentative in making the full-time commitments, the desire to go for temporary hirings is very high, and this puts a staffing firm like Manpower, which has a global presence. It's a U.S.-based, Milwaukee-based firm.
Yep.
About $4.5 billion in market cap, roughly $23 billion in revenue expected this year. And only about 10% of that would come from the U.S. So it's a very, very global firm. Very strong relationships with corporate players around the world, as I mentioned, heavily industrial focused and clerical. And that's the primary reason for why we have them performing very good over the coming quarters, despite the labor market being as weak or soft, whichever adjective you want to use. And we are seeing that in estimates too. Estimates, they blew past expectations in the last quarter. Yeah. The trend for the current quarter looks very promising. Estimates have been going up. And we have historically seen that when estimates go up, the stock follows. They have an excellent balance sheet. On top of that, they pay a fairly decent 1.5% dividend as well.
Overall, a very strong brand. They've been around forever.
That's right.
Sears Holding Corporation is the Bear of the Week, SHLD, the ticker symbol. Now, this company's been in the news a lot lately.
That's right. Sears, the holding company, basically brings together the Sears brand and the Kmart brand under the Sears Holding umbrella. Eddie Lambert, a very well-regarded hedge fund manager a few years back, got hold of Sears and then brought together Kmart with it, with the hope and expectation that he will turn around these tired brands, which by all means have been beyond their prime. And it was a tough job to begin with, even in the best of times, but when the economy went south, it made his job particularly difficult. His focus, and he's been accused of this, his focus has been more on cost cutting and bottom line centric, and that's not really favorable to the merchandise mix or revitalizing the brand and the presence of these two brands across the board. So across the board, we are seeing tough comparisons, and the stock is under pressure.
All right, we're going to pull up a stock screen here next. Screen of the Week, an overview of a timely strategy aimed at helping you become a more effective stock screener. This week we're talking about new top 5 sectors. Top new 5 sectors. Kevin Matris will fill us in on just exactly what it's called and what it's all about. He's our top stock screener here.
Makes sense no matter how you say it.
I know, nonetheless, this is one that you like to run every couple of months or
Right.
so.
That time again.
And why is it important to run it every couple of months? It's kind of often, isn't it?
Yeah, well, now I believe it's especially important, especially after the 6-week correction that we had just seen in the market. But quite frankly, I believe it is important to always stay abreast of what's happening when you stop and consider that roughly 50% of a stock's price movement can be directly attributed to the group that it's in. So by definition, a strong sector or a strong industry will be one where the majority of the stocks are going up. You cannot have a sector or an industry be considered strong if the majority of your stocks are going down. Mm-hmm. Now again, that doesn't mean that you can just pick anything and you're going to make money, but it does underscore the importance of being in a strong group. So again, you want to make sure that you're looking at the strong groups, because I've actually done a study a long time ago. The study I did showed that sometimes just getting into an average stock, a mediocre stock in a very strong group, will actually outperform one of the best stocks in a crummy group. So again, getting into the best group, very, very important.
All right, well, it makes sense. Mm-hmm. How then are you defining best sectors?
Well, there are several ways that you can define a best sector or best industry. One of my favorite ways is to be able to look at the percentage of stocks trading within 10% of their 52-week high. Specifically, what I am doing is I will calculate how many stocks are trading within 10% of their 52-week high. I will divide that by the number of stocks within the group, and the highest percentage will be ranked as the best sector. Now, some people like to use the percentage price change over the last 12 weeks or 24 weeks, and I think that's fine, but I personally don't believe that that is sensitive enough. Because if you're looking at a group that, let's say, has been doing fantastic, outperforming all the other groups for the last 12 weeks or 24 weeks, but then all of a sudden you see a significant correction, oftentimes that significant correction can get lost within the huge run-up that preceded it. But the moment your stock pulls back from its 52-week high, you're going to see that that reflected in its rankings. So I believe this is one of the best ways to look at the groups.
Okay. And what are the new top 5 sectors?
The new top 5 sectors for this week are as follows. You have utilities with 49% of the companies trading within that 10% range. Consumer staples, 45%. Finance, 33%. Then you have conglomerates and retail wholesale. Oftentimes, you'll see the percentages higher. But because of the correction that we had seen, that's why you're looking at the lower percentages, but it's still important to concentrate on the ones with the biggest numbers.
All right, and some stocks that came through?
Yeah, here are 5 stocks. Each one of these stocks represents one of those top sectors. So you have Alliant Energy, SJ Smucker, Discover Financial, ITT, and Interactive. Each one of these companies is in a top group. All of these stocks are on the move, and a lot of these are trading near their highs as well.
About how many stocks per sector do you get?
It really depends, but oftentimes you may see as many as, 500, 600. Finance has, I believe, like 1,500.
Okay. Own any?
I do have Discover.
All right. More still ahead. Stay with us. Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. Well, as you heard me say at the top of the show, there were 2 main economic reports that came out this week: durable goods orders for May and the final revision to the GDP growth number. Which carries more weight as far as the markets and investors are concerned? We're going to find out from our roundtable members. Shiraz Mian, Research Director, Senior stock strategist Kevin Cook joins us once again, and market technician Kevin Matris back with us, and you saw him earlier in the show as well. You floated through this entire show today,
Nice.
Matris.
I like that.
All right, so durable goods orders for May, a little bit better than expected. GDP, third revision to the first quarter number, 1.9, right in line with analyst expectations. Kevin, which carries the most weight? Kevin Cook, which carries the most weight?
As you touched on, GDP was pretty much in line with expectations, maybe 0.1 better.
Yep.
Durable goods is kind of a nice surprise that it was better than expectations, because last week we got bad news on the manufacturing front from two of the mini ISMs from Philly Fed. And so, that's encouraging, especially in light of the Fed forecasts earlier in the week.
Yeah. So in your mind, durable goods carries more weight.
Yeah, only because the GDP number is the final. It's the third entry. Tidy it up. It's done. Right. And not a big surprise there.
Right. Okay. Shiraz, how about you? You thinking the same thing?
Yes, the GDP number is essentially kind of keeping the record straight. We are getting to the end of the second quarter. Now it's good that the first quarter number was a little bit better than what was initially reported, but that's way past history. The important thing is manufacturing and the health of the industrial sector, and the durable goods number gives us a more reassuring read on that key sector.
All right, Fed Chairman Bernanke spoke this week about the economy. Didn't have anything much positive to say about the economy, but something stood out for you, Shiraz. What was it?
It was in the news conference, the Fed chief, while discussing what was causing the slowdown in the first half, referred to the Japan and the fuel increases and the weather issues as partly responsible for the slowdown. And he also mentioned something which had never really come out before in the discussion in the market, which was that maybe the structural issues in the banking sector, the balance sheet deleveraging going on, that those may have been much more severe than any of us thought. But my overall takeaway from that answer from the Fed chief was that he was basically saying that we don't really know why the economy is really slowing down, other than what's happening on the fuel front and from Japan.
For the first time, he's leaving people with the impression that, I don't know.
If the main person who is supposed to be keeping a watchful eye on everything in the economy, hearing from somebody like that, in effect that he doesn't know, or he's not clear, or he's uncertain or tentative, that in my view was a fairly negative thing.
Well, Kevin M is always clear. That's one thing we can always count on. What are you making out of all this week, Kevin?
Well, it's interesting because the Fed has been the most optimistic voice really for the last couple of months. So when they came out all flummoxed over why things are slowing down, that I think really did spook the market, and you could see the market immediately react to it. However, though, if you were to put a silver lining on what he had said, let's think about it. He's still looking for, the Fed is still looking for a growth rate of between 2.7 and 2.9%. That's only a couple of basis points lower than what was earlier forecast. If you look at the GDP, we're at 1.9%. So his prediction of still expecting to see the economy grow in the second half is still intact. Yes, his uncertainty does kind of cloud things up a bit, but you're still looking at a pretty good growth rate for the next 6 months, and I think that is the takeaway from Bernanke's speech.
So Kevin Cook, is the revised Fed forecast for growth for the second half of the year and the Bernanke comments combined going to set the mood for the rest of the year?
I think so.
At least in the market.
And so he, as Kevin said, he's been the most optimistic voice, but maybe he shifted from mildly optimistic to cautiously concerned. And as Shiraz and I have talked about, we've gone from the transitory word to maybe enduring structural issues. So, so if you look at, well, what does it take to get to 2.7 to 2.9% for the year? Remember, these are annual figures. So Shiraz, would you say it's going to take 3% growth based on the 1.8 and the 1.9
That's right.
to get to somewhere in 2.8, right?
Yeah, no, it is on the optimistic side, I would say.
Okay, I got to move. Give me your top stock pick.
I have a REIT, Avalon Bay. It's an apartment REIT. The trade-off between owning and renting is favoring renting. Avalon Bay has good locations in Washington D.C., in New York, and in California and San Francisco. These are high barrier to entry markets. REITs don't have that much correlation with the other equities, so they provide good diversification and a good dividend-paying stock on top of it.
Okay, Kevin C.
Freeport-McMoRan. I wrote about copper stocks this week. I like copper bottoming between $3.75 and $4. If you're thinking double-dip recession, that's off the table. But I like the emerging markets growth story still. Freeport pays a 2% dividend. It's got a forward PE of 8. And I like Southern Copper, too, which pays a dividend of 7%.
So, what is it about copper that everybody's attention is?
Well,
seems to be going now?
it's got the PhD in economics, right? And if you believe in the emerging market story that 2 billion people around the world want to have the lifestyles that Americans do, that the developed world does in Europe, then you're building urban infrastructure, and you can't do that without copper.
Okay, interesting. Kevin M.
Real quick, Lithium Motors, ticker LAD. They are in the retail, wholesale, auto, tire, and trucks industry. They pretty much do everything in regard to the automotive industry. What I like about it is they are in a top sector. They're a top stock within the top sector. They have double-digit projected growth rates for the next 2 years. They just posted a 70% positive EPS price. Chart-wise, they just broke out of a nice consolidation pattern. I have a price target of $22.45. That is a 21% increase from here.
Shiraz, quickly, anything strike you about the fact that we're going to be kicking in 30 million barrels of oil from the oil reserves this week?
It was a complete surprise, came out of the blue, and I'm still scratching my head as to why they did it.
Okay, thank you for being with us. This is going to be the final installment of Profit from the Pros. We hope that you've enjoyed what you've seen here, and if you have, you can still see some of these same features as standalone segments on our website, Zacks.com. Thank you for watching.